Are you prepared? Because inflation is about to hit like a rocket. Billionaire Bill Ackman sees it coming, but you know what? This ain't the apocalypse. It's your launchpad to millionaire status. We're talking about secret strategies used by the wealthy to thrive in chaos, a step-by-step guide to exploit this boom, and the chance to build a fortune that inflation can't touch. Let's secure your financial future. We'll crack the code behind Bill Ackman's warning, unlock the hidden wealth-building tactics of the 1%, and show you exactly how to turn this crisis into your personal golden age. It's time to stop fearing inflation and start profiting from it. Albert Ackman is a well-known American billionaire hedge fund manager who founded Pershing Square Capital Management, a hedge fund company. Over the last 2 decades, he has gained a reputation as a bold and outspoken investor, consistently making significant financial moves. Despite not all of his decisions proving successful, Ackman has managed to deliver an impressive 635% return to his investors since 2004. In a recent rare full-length interview, Ackman, known for not always sounding alarm bells, discussed his concerns about inflation. This caught the attention of many, considering his usual approach to investing. Before getting into his practical strategies for profiting amid inflation, let's first explore why he believes inflation is imminent, and why he believes it will persist for a long duration. Portfolio. Great businesses, we think, do well in really any economic, political, or AI environment. We opportunistically hedge risks, and the 2 risks we've been concerned about really over the last year and a half are energy prices and the longer part of the Treasury curve. Rates moving up. We have an economy that is still strong and inflation, 3.5–4% persistent. But, our view is basically you're not being paid enough to enter into a 30-year contract with the US government at a fixed price, 4.7 or where it is now. It doesn't make sense in a world where we think structural inflation is north of 3% for the very long term. We went through this unusual period with extremely low interest rates, where everything just got cheaper. And since the financial crisis, the effort of the Federal Reserve was to make sure we didn't have deflation. The aspirational goal is to get to 2% inflation, and then the pandemic, and trillions of fiscal stimulus. The psychological stimulus of being free to roam after being locked up. All of these factors coming at once kind of lit inflation. And we still have this massive deficit spending. We still have infrastructure spending. The government's selling literally hundreds of billions of dollars of securities. The Federal Reserve, it's an imprudent balance sheet. If you think about the United States, right? If this were like a business, you wouldn't have so much short term. You wouldn't have, a third or more of your debt repricing within the next year. So it's not been managed, in all honesty. The current rate of price increases is reaching levels not witnessed in a long time, comparable to the situation in the early 1980s. Back then, there was prolonged concern about remarkably low inflation, with worries even extending to the possibility of deflation, where prices decrease instead of rising. In 2012, the Federal Reserve, considered the nation's monetary authority, set a goal of maintaining a consistent 2% inflation rate annually. However, achieving this target proved more challenging than expected. Contrary to the initial perception that future price increases wouldn't be a great concern, inflation is fundamentally influenced by the balance between the availability of goods and the demand for those goods. To see an example, consider the years 2020 and 2021. During this period, the government facilitated increased money circulation through direct payments and low borrowing costs. While this may seem positive initially, it can have adverse effects on the economy in the long term. The greater availability of funds gave more people the ability to purchase items like used cars. However, simultaneously, there was a shortage of essential parts for car manufacturing, leading to a reduction of new car production. This resulted in people holding onto their older cars for more extended periods, causing a diminished supply of used cars. Consequently, the scarcity of used cars led to a surge in their prices. In essence, the delicate balance between demand and supply plays the main role in driving inflation. If you find the video enjoyable and helpful, subscribing is free and it supports our growth, allowing us to bring even more value to you, so don't forget to hit the subscribe button. If you're familiar with Bill Ackman, you'd know he has a keen sixth sense. And currently, his intuition suggests that the soaring prices we're witnessing aren't merely a temporary situation. Instead of overlooking the broader perspective, he's stepping back and observing various signs indicating that a big change is on the horizon. The global political and economic landscape is undergoing unusual changes, and the once cost-effective option of manufacturing overseas is now becoming more expensive. These evolving dynamics are out of ordinary. Also, there's a growing demand from workers for higher pay to offset economic effects. The recent spike in gas prices further adds to the challenges, with many struggling to afford consistent fuel for their cars. Some are even contemplating selling their vehicles due to the burdensome daily maintenance costs. This brings attention back to the Federal Reserve, whose primary role is to maintain stability and ensure the well-being of our hard-earned money for everyday expenses. Currently, they might be inclined to increase the cost of borrowing money, hoping to temper the rising prices. While this strategy has shown some effectiveness in reducing the high levels of inflation experienced earlier this year, there's still a worrisome flip side to consider. Whether you believe it or not, if Bill Ackman's predictions come true and prices persistently remain high, there's a real possibility that the already elevated interest rates could climb even higher. Consider for a moment the potential impact on the stock market. As an investor aiming to achieve financial goals, the thought of such a scenario might be nerve-wracking, as it could send shockwaves with great repercussions. But don't lose hope. It's not all bleak. Bill Ackman also foresees that we will adapt to this possibility, just as we have in previous years. Interestingly, he points out that historically, businesses can thrive in inflationary environments, provided their costs don't inflate as rapidly as their revenues. From a historical perspective, the value of a business is determined by the present value of the cash it can generate over its lifespan, discounted back at an appropriate interest rate. This is precisely why Ackman feels comfortable owning such businesses, even in the face of persistently high inflation. To emulate Bill Ackman's winning strategies, we need to get deep into his investment philosophy, which closely aligns with Warren Buffett's. Interestingly, both draw influence from Ben Graham's book, The Intelligent Investor, in shaping their approaches. Ackman identifies as a value investor, constantly seeking solid, competitive companies that he believes the market undervalues or underestimates. He adopts a long-term approach, characterizing Pershing as an investment holding company rather than engaging in short-term flips. Ackman's success as an investor is rooted in his mindset, consistently generating substantial profits regardless of challenging market conditions. And did you know that his massive $1 billion investment fund is strategically distributed across only 7 firms? His portfolio spans diverse industries, including restaurants, Chipotle and Restaurant Brands International, transportation, Canadian Pacific Railway, real estate, Howard Hughes, hospitality, Hilton, home improvement retail, Lowe's, and technology, Alphabet, the parent company of YouTube and Google. Upon scrutinizing Ackman's portfolio, 2 key characteristics stand out. These companies not only have the potential to endure inflation, but may also capitalize on it. In fact, some of the firms in his portfolio could see improved performance if inflation rises. This strategic focus on resilient and potentially inflation-resistant sectors exemplifies Ackman's approach to navigating the complexities of the market. The first noteworthy feature in Ackman's portfolio is the asset-light approach, a term favored by experts. This refers to companies that don't require extensive physical assets to operate successfully. A prime example of the opposite is the airline industry, known for its significant asset base. For instance, American Airlines owned approximately $40 billion worth of aircraft, surpassing the company's overall market value. On the flip side, consider Restaurant Brands International, RBI, one of Ackman's portfolio companies. Operating on a franchise model, RBI doesn't own the physical restaurants. Local franchisees do. RBI simply collects fees, often a percentage of sales, without the substantial costs associated with property and equipment. This structure not only makes RBI resistant to inflation, but also allows its earnings from franchise fees to potentially increase with rising prices and sales, creating a favorable scenario. The second key feature of Ackman's portfolio is pricing power. This term refers to a business's ability to raise prices without losing customers. Take Canadian Pacific Kansas City, a railway company in which Ackman has invested. Due to its essential service of transporting goods over long distances, it is often chosen over costlier truck deliveries. This gives the company the leverage to charge more if necessary, showcasing its pricing power. Now, let's shift our focus to Chipotle, another of Ackman's picks known for its strong pricing power. Chipotle has cultivated a dedicated customer base over the years, remaining loyal even when menu prices increase during periods of peak inflation. This loyalty reflects the strength of the brand and its ability to maintain customer trust in varying economic conditions. Recalling the similarity in investment strategies between Bill Ackman and Warren Buffett, consider Coca-Cola, a brand cherished for its strong and loyal customer base. Such household names like Chipotle and Coca-Cola are perceived as hard-wearing even when their prices exceed those of competitors. Warren Buffett also favors Apple, a brand that, while not the most innovative tech company anymore, retains a devoted fan base. Customers continue to invest in Apple products to stay connected to the Apple ecosystem. Interestingly, instead of complaints about Apple's devices being among the most expensive on the market, the company is perceived as a luxury brand, reinforcing the loyalty of its customer base. Ackman's investment strategy revolves around businesses that function as royalties in their industries, benefiting from industry growth and effectively navigating through inflation. While the outcomes of his insights on inflation and interest rates are yet to be seen, it's essential to note that not all sectors are favorable during inflation, particularly those related to durable goods and retail, where spending tends to drop significantly. If venturing into these sectors, thorough research is important too, weighing the pros and cons of the firms. To mitigate losses during periods of rising inflation, maintaining a diversified portfolio with bonds, commodities, and inflation-protected investments is a popular and relatively safe strategy. However, it's important to know that even seasoned investors like billionaire expert Bill Ackman don't get things right all the time. Traditional inflation hedges may not work in every scenario, and unique economic conditions can yield surprising results on unexpected assets. That's all for today. If you find the video enjoyable and helpful, subscribing is free and supports our growth, allowing us to bring even more value to you.